Hi, I'm Gary Carruthers, the director of the Senator Pete V. Domenici Public Policy Institute at New Mexico State University. We were delighted when Senator Domenici donated his papers to New Mexico State University in 2008. But in addition, he wanted to set up a policy institute which brought some of the finest minds in the United States to our campus here at New Mexico State University to deal with all kinds of public policy and business issues. So we're delighted to offer to the television audience and the audience here in the studio one of the finest bankers in the United States, a person that we're delighted to have in our region. And here to introduce our guest speaker for today is President Barbara Couture, the 25th president of New Mexico State University. She came to us from the University of Nebraska at Lincoln. Before that, she was at Washington State University, and prior to that, Wayne State University in Detroit. She has a degree in English from the University of Michigan, so we try to keep our sentences short to minimize mistakes. And we rarely write emails to her because of that same problem. But I'm delighted now to introduce Dr. Barbara Couture, the 25th president of New Mexico State University.
And thank you, Dean Carruthers, for those very lovely few short sentences. Hello and welcome to the Spring 2011 Domenici Institute Forum, where we're soon going to hear from our special guest, Richard Fisher, the President and Chief Executive Officer of the Federal Reserve Bank of Dallas. This is New Mexico State University's second Domenici Institute Forum, an extension of the university's yearly Domenici Public Policy Conference. We use these forums here at NMSU as a way to bring important leaders and speakers to campus, to engage the public, and encourage them to discuss and take part in important issues. Our guest this afternoon, Mr. Fisher, serves as president of the Federal Reserve Bank of Dallas, which means he's also a member of the Federal Open Market Committee, the Federal Reserve's principal monetary policy-making group. The Federal Reserve Bank of Dallas serves the 11th Federal Reserve District, which consists of Texas, northern Louisiana, and southern New Mexico. Mr. Fisher is former vice chairman of Kissinger McLarty Associates, a strategic advisory firm chaired by former Secretary of State Henry Kissinger. He was a Weatherhead Fellow at Harvard in 2001. He is an honorary fellow of Hertford College at Oxford University, and he is a fellow of the American Academy of Arts and Sciences. Mr. Fisher is a first-generation American, and he is equally fluent in Spanish and English, having spent part of his life in Mexico. Thank you again for attending the Domenici Institute Forum. Please join me now in welcoming Mr. Richard Fisher.
Thank you, Dr.
I want to thank Dr. Couture. It's high education, so I can refer to her as haute couture, I assume. I also want to say how nice it is to be at this great university. I was in Chicago yesterday. I'm up in Boston tomorrow. It's nice to be in the heart of the country, and particularly here. I am very happy, too, to see you, Governor, Dean, Admiral, whatever titles he's had in his lifetime. Laura Conniff, who's on our board at the El Paso branch of the Dallas Fed, is the one who really made this possible, and I always honor her. It's her input and her wisdom that helps us and guides us at the Federal Reserve Bank of Dallas. So it's a pleasure to be here. I'm going to, this is always a warning sign, Governor, and you know this. I'm going to keep my comments as brief as possible this afternoon. I want to leave ample time for the questions from these great students we have seated in front of us here. I want to first provide a bit of a summary, a précis of the, how I see the nation's economy. Very much like I presented at the Federal Open Market Committee last week on behalf of the citizens of the 11th Federal Reserve District, including the citizens of Las Cruces and southern New Mexico, as you mentioned, Madam President, in your introduction. And second, I want to discuss inflation as we see it at the Dallas Federal Reserve and price stability. But before getting on to these weighty matters, let me demystify the Federal Reserve System and the role of the Dallas Fed within that system. We have a dollar bill on the screen here, and if you look closely at that note, you'll see a letter printed on the left-hand side of President Washington, actually the right-hand side left as you proceed the bill. It's the letter K. It bears that imprint because we are one of the 12 Federal Reserve banks. There are 12 Federal Reserve banks in the system, starting with A for Boston, B for New York, all the way through L for San Francisco. Dallas Federal Reserve dollars are identified by the letter K, surrounded by two concentric circles. The outer circle says Federal Reserve Texas, forgive me. The inner circle says Bank of Dallas. And we, of course, as you know, Doctor, as an English professor, and I know you know this, K is the 11th letter in the alphabet. And so the Federal Reserve Bank of Dallas is responsible for the administration of the Federal Reserve affairs in the 11th of the 12 Federal Reserve districts as they were set up by the Congress of the United States in the Federal Reserve Act of 1913. And presently there are about $1 trillion of Federal Reserve notes. It's ones and twos and fives and tens and 20s and 50s and hundreds in circulation. Actually, to be exact, there are 903 billion presently in circulation. And of course, I want you to know that my district, the 11th Federal Reserve District notes, have greater nominal value than all the rest added together. Now, the economic activity conducted in the 11th Federal Reserve District covers that of 27 million people, covering 360,000 square miles of territory in southern New Mexico, as you mentioned, Texas, and the wooded north of Louisiana. It's serviced by our Federal Reserve Bank in Dallas, what we call the Mama Bank, and 3 branches, very importantly the one in El Paso, and also one in Houston, and one in San Antonio. First, I'd like to explain what I do. I'm president of a $98 billion bank. That bank operates, I want to note, at a profit. It's a profit that we all collectively, the 12 of us, pull together after we pay off a small preferred dividend to our member banks and return to the United States Treasury. I'm happy to tell you that the 12 Federal Reserve banks last year, that is for the year 2010, returned $79 billion to the American taxpayer out of our profits. And the year before that, roughly $43 billion. So I want you to know you're looking at one person in the United States government that actually makes money for the US taxpayer. So what do we do for those 27 million people in our district? For starters, we make sure that you have the cash that you need. In the first quarter of this year, the Dallas Fed distributed and received almost 1.5 billion circulating banknotes worth nearly $27 billion in face value. We have mammoth machines, including here in nearby in El Paso, that scan 100,000 bills per hour. They process them so they can be shipped from our vaults in El Paso and Houston and Dallas to banks throughout the district so that our citizens have their folding money. Of course, in addition to making sure there's a sufficient amount of money in circulation in our district, we have to make sure that our money is valid and looks respectable. So each month we call hundreds of counterfeit bills. We pluck out about 36 million worn bills that have lived a full life. We shred them, and I like to say we send them off to money heaven. We replace them with new crisp notes. We also have historically at the Federal Reserve processed checks. Now I have 6 handsome young people and beautiful young people seated in front of me. They don't even know what a check is. So as you know, as our society has evolved and checks and electronic forms have replaced checks, even though in 2009, Governor, the Dallas Fed processed 120 million paper checks, we no longer do so. Since the use of paper checks has been and will continue to be on a substantial decline as consumers and businesses take up electronic counterparts, the Federal Reserve decided to consolidate all paper check processing with the Federal Reserve Bank of Cleveland. And we figured since they lost LeBron James, we had to give them something from that city. And then the Federal Reserve Bank of Atlanta will serve as the sole electronic check processing site for our entire Federal Reserve system. Another important function of the Dallas Fed is to provide liquidity to district depository institutions through what we call our discount window. In other words, to be the ultimate banker's bank. Those in the room that are affiliated with depository institutions are certainly aware of this vital function. The lending programs that make up our discount activity, our window, help relieve liquidity strains by providing a source of short-term funding, which is, by the way, fully secured and fully collateralized. We've not lost a dime on any loans that we've made to depository institutions. And this is to help them conduct uninterrupted business on behalf of you and other customers. In 2009, we made 594 loans approximating $30 billion in total size. And just to show you how the demand for those loans has decreased as the great panic of 2008, 2009 has come down, in 2010 we made 156 loans for only $3 billion. And that activity at the discount window now is very much de minimis. I chair our credit committee at the bank. I personally review the loans that we make every evening. I question them occasionally. And the size and structure depends on the needs of the borrowing bank. Among our other responsibilities is supervising the banking industry within our district here in New Mexico and southern New Mexico and in Texas and Louisiana. We conduct on-site audits of our state chartered member banks and bank holding companies, and we monitor bank performance and stability using electronic surveillance technologies. Currently, we supervise 37 so-called state member banks and 522 bank holding companies in our district. And in June of this year, thanks to the Dodd-Frank bill recently passed by the legislature of the United States, we'll take on responsibility for supervising the activity of savings and loan holding companies, and we currently have 92 of those in our district, so we'll be adding them to our responsibility. This supervisory role is very important. I began my career as a private banker at the firm of Brown Brothers Harriman, and my superiors instilled in me an overarching principle, one that I'm sure the bankers in this room are very familiar with, and that is you know your customer. Well, we at the Fed rely upon our regulatory relationships to better know our customers. We actively monitor our constituents' needs and services on the front line of the commercial banking industry, and we use this insight to be better lenders to all of our customers. Without that supervisory and regulatory responsibility, we could not operate responsibly or effectively as the nation's lender of last resort. Moreover, the knowledge gained through banking supervision aids in the formation of monetary policy. The Dallas Fed also organizes public education programs designed to raise financial and economic literacy in our community and in our nation. We frequently host public events and conferences on significant activities within our economy. And not unimportantly, we work with universities and high schools throughout our districts. Our team at our El Paso branch, for example, works with students at this great university in their what you call the Doctor of Economic Development program, which allows students to participate in internships at that branch of our bank. We have partnered with your university, Dr. Couture, to coordinate and sponsor the Collegiate Advisory Board. It's an independent study program. And we've developed a student board of directors program for the top high school students in the Las Cruces School District. So currency processing, banking supervision, lending as a banker's bank, and public education efforts are very much integral parts of the Federal Reserve's job. You wouldn't know it from reading the newspapers, with all due respect to the media in the room. They're not the parts of central banking that usually garner the most public attention. The sexier bits of what I do, if you can consider anything a central bank does, is sexy. Deal with monetary policy. So let me explain how that works. The president of the 12 Federal Reserve banks, in addition presently to the 5 governors of the Federal Reserve Board, normally meet every 6 weeks to discuss the current trajectory of the economy and craft appropriate policy response. We do so in a meeting of what's known as the Federal Open Market Committee, as you kindly mentioned in your introduction. We use an acronym, the FOMC. It's in these FOMC meetings that we set the base interest rate for interbank lending, known as the Fed funds rate, and where we develop other monetary policy initiatives like the various programs we put in store to restore liquidity in the commercial paper, the mortgage markets, the asset-backed securities, and other markets during the great financial crisis of 2008 and 2009. I come to each of these FOMC meetings armed with input from our research team that provides the intellectual heft for an informed monetary policy making, as well as insights provided by our board members, including Laura, sitting here in front of us, and our other directors, and from the many businesses, small and large, that populate my district with whom I am in constant touch. The Dallas Fed employs a crack team of economists and analysts who study the local, national, and very importantly, the international economy, and their work is top-notch. A few of you might know, for example, that Finn Kidlin, who's an advisor to our research team in Dallas for the past 15 years, won the Nobel Prize in economics in 2004. The FOMC is one of the few public decision-making bodies in the world where members come together and in the span of only a few hours present their positions without fear of political retribution and without posturing for the cameras. Then they hammer out agreement on a course of action based solely on what they solemnly consider judicious for the long-term health of our economy rather than for their short-term effect or for political convenience. On the afternoon in which we conclude our discussions, we craft a statement for public release explaining the actions we take, and we then release a lengthy set of minutes of our deliberations 3 weeks after our meeting. So it's the Federal Open Market Committee, the FOMC, where southern New Mexico and the wooded parts of Louisiana and the state of Texas have a voice in the policy-making table for the most powerful and essential central bank in the world. The President of the United States appoints and the Senate confirms the governors of the Federal Reserve System. The 12 Federal Reserve bankers, like me, who sit side by side with those governors, are not subject to that political process. We are hired and fired if they choose to fire us. I hope, Laura, you don't choose to fire me. By 9-member boards of directors that represent the financial institutions and stakeholders and economic diversity of our respective Federal Reserve districts. I want to make this clear. I am not accountable to any Washington politician, be they Republican or be they Democrat. I'm politically neutered. I'm devoutly nonpartisan, and I am guided solely by what I believe is the best way to craft policy so as to encourage sustainable economic growth and price stability, regardless of who's in the White House, regardless of who controls the Congress. I work hard to represent the views and ideals of my part of the country. My fellow bank presidents and I represent Main Street, not the Washington establishment, nor the Wall Street establishment. I want you to know that every time I speak or intervene at an FOMC meeting, which by the way is quite often, I am a Texan, I do so very much with that in mind. Which brings me to the current economic situation. Despite being hit by a variety of shocks last year and earlier this year, the economy continues to recover. Last year, concerns over the euro debt crisis and uncertainty over health and financial reform slowed the economy's momentum during the summer. But the economy shook off those drags and reaccelerated late last year, reflecting a combination of policy stimulus and the ability of the U.S. economy to reinvigorate itself. More recently, bad winter weather and an increase in energy prices have sapped some steam from the recovery. Nevertheless, a host of more timely indicators suggest that economic growth will likely pick up in the coming months. The recovery in manufacturing and a bounce back in capital goods orders are particularly heartening. Not only do they contribute towards an economic recovery, but they're also harbingers of a needed rebalancing of our economy. During the credit boom of the prior decade, we became too dependent on consumption and housing for our economic growth. We borrowed too much, we had unsustainable trade deficits, and we did not invest enough in business capital, job-creating business capital. The good news today is that we're making headway in shifting the mix of growth in our economy. Our manufacturing sector is recovering as we export more and as our entire economy invests more in equipment and software. In the long run, that will raise our productivity, it will raise our living standards. And that's the kind of recovery that will not only restore jobs over the long term, but will also be more sustainable and will help bolster the living standards of our citizens. Shifting to prices, we've seen inflationary impulses gaining ground both at home and abroad. An astute reader of this morning's Wall Street Journal would have looked at page A12 and seen that it reported data released yesterday by the Organization for Economic Cooperation and Development, known as the OECD in Paris, that showed that consumer prices in 34 member countries rose 2.7% in the last 12 months, driven largely by food and energy prices. Of note, industrial producer prices in the European Union rose 6.7% year over year, the steepest annual increase since September of 2008. And September of 2008 was just as the financial panic broke some of the inflationary thrusts that have been gaining steam throughout the summer and course of that year. At the core of the Eurozone, Germany, where unemployment is actually lower than it was before the financial crisis, wage inflation is now pressing up against 3%. Retail price inflation in the United Kingdom now exceeds 5%, despite very high unemployment. Reported inflation now exceeds 5% in China, 6% in Brazil, and 10% in India. In the United States, as many of you have experienced firsthand, higher energy and commodity prices have reduced the purchasing power of many households. According to the latest readings, headline inflation increased at an annualized rate of 4.9% in March, after clocking in a 5.1% increase in February. Now, numbers like these make any central banker's heart skip a beat, especially mine. Yet here and abroad, a closer look at the numbers will reveal that energy and food prices, notoriously volatile items, make up a significant portion of these increases. This is not to say that these numbers are unimportant. They're clearly worrisome, and we are following them very closely. But our job as policymakers is to focus on underlying inflationary pressures so as to avoid overemphasizing temporary volatility that might lead to faulty conclusions about the conduct of monetary policy for our economy. So the question one should ask is, what is the best way to measure future inflationary trends? Headline inflation, important as it is in measuring the rise in someone's cost of living, accurately describes past inflation, but it's not as informative as one might think for detecting and predicting future inflation. For that, counterintuitive as it may seem, it helps to exclude some of the more volatile components of the inflation indices. This is why central bankers around the world pay such close attention to underlying measures rather than just the headline inflationary number. Underlying price movements are more useful in predicting future inflation trends. Now, we at the Dallas Fed have come up with a separate and distinct way of calculating this core inflation as it's referred, and we call it the trimmed mean analysis. Developed by a senior economist at the Dallas Fed named Jim Dolmas, this measure looks at price movements of 178 items, personal consumption expenditure items that matter to the average consumer in a series that goes back to 1977. We then strip away both the highest and the lowest monthly price increases for categories of goods and services in order to get to the underlying trend. And this trimmed mean inflation rate has become a key component in my economic toolkit, allowing me to better gauge the direction and speed of approaching inflationary winds. Over the past 6 months, the trimmed mean inflation rate, while rising, has run at a somewhat sedate rate of 1.3%. though it has risen from a low of 0.7% in mid-2010. The 12-month inflation rate rose from a low of 0.8% in the second half of 2010 to 1.1% most recently. These numbers excluded items with extreme price increases on a monthly basis, such as gasoline and many food items. We also incidentally trimmed out items with extreme price declines, such as toys and natural gas and wine and other items. Among the items that were included to ascertain the underlying trend of prices were physician services, rent, tobacco, dining out, the cost of health and life insurance, sporting goods, guns and ammunition, very important in my constituency, and child care costs. And as the son of an Australian, I noted with extreme interest that the medium item, the one smack in the middle, was beer. Homer Simpson would be so proud. I also noted that the number of falling items in the basket has been declining. The number of declining items has been declining to what has been a historically normal level of about 30% of what people consume. This trend is in the number of items actually declining in price has been in place for a while, which is what convinced me early on that the risk of deflation was not as high as some of my other colleagues at the FOMC surmised. The point is that as of now, the higher gas and commodity prices have not translated into more general price inflation numbers. My gut, however, tells me that we cannot afford to become complacent on this front. We know from anecdotal soundings from American businesses, like businesses in other countries, that they're doing their utmost to offset with higher prices the surging costs of inputs such as fuel and other commodities and materials and components, parts and process that they source from abroad. As Chairman Bernanke mentioned in his press conference last week, our job is to keep those from passing into price and wages throughout the economy and creating a broader inflation. Such a result would be much more difficult and much more painful to extinguish. We at the Fed are committed to keeping inflation low and maintaining the credibility so painstakingly taken and gained by former Fed Chairman Paul Volcker. And I personally will remain steadfast in my resolve to keep inflation low and stable. Now, in monetary parlance, I'm known as a hawk. It's a description with which I feel very comfortable. I've pointed out to many of my friends many times, ornithologists classify doves as being from the pigeon family. I don't want to be anybody's pigeon. Nor am I alone in my firm commitment to keeping inflation under control. As Chairman Bernanke commented during last week's inaugural press conference, if we're going to have success in creating a long-run sustainable recovery with job growth, we must keep inflation under control. I'm very confident in our ability to do so. So bottom line, with regard to the economy, I'm going to try to mix generations here, Governor. With regard to the economy and economic growth, like the music of Wagner, the pace of economic growth is not as bad as it sounds. With regard to inflation for the younger generation, like gangster rap, it's not as good as it sounds. To counter the recession and ward off the risks of deflation, the Federal Reserve has provided an enormous amount of stimulus to the economy in the past few years. In my view, we have done as much as we can to supply the liquidity needed to restore economic growth. Now, as Ben Bernanke made clear in his press conference last week, we must remain sharply attuned to movements of underlying inflationary forces. Should it prove necessary to counter inflationary pressures, I can tell you this. Representing you, I will be among the first to advocate the unwinding of some of the stimulus that we have provided and returning monetary policy to a more normal stance. And now, in the great tradition of central banking, with these brilliant students in front of me, I'll do my very best to avoid answering any questions you have. Thank you very much.
Come on over, Richard. Thank you very much for an outstanding address. Richard, I wouldn't say that that was sexy as you started off with, but I would certainly say it was interesting and entertaining.
Well, thank you.
And it's pretty difficult sometimes to make the work of the Federal Reserve both interesting and entertaining at the same time. Wonderful job. I'm sure our audience enjoyed it very much. One of the traditions in the Domenici Institute has been since its inception is we like for students to ask questions of the great minds that we bring to our campus. And so we're going to start our discussion today with you by turning to our students. Some are from New Mexico State University and some from high schools here. Interestingly enough, I think this is the first year since I've been dean that your program, the Federal Reserve, has been in place with our College of Business at New Mexico State. But I'm going to ask the students to identify themselves and which school they come from, and ask Richard the hardest question you possibly can.
Thank you, Dean Carruthers. My name is Patrick Wagner, and I'm a senior at New Mexico State University. And I had a question for you, President Fisher. In your opinion, what was the greatest tool that the Federal Reserve used to implement sound, positive monetary policy during the last recession?
Well, there were several tools. I can't say we had the greatest tool. You have to remember, we are the lender of last resort. We had a massive shorting out of the financial system. Lehman Brothers failed. Bear Stearns went bye-bye. AIG had its problems. They were not under our regulatory scrutiny, nor under our supervision. But we are, to use a modern term, we are the first responder in the case of financial disaster. This is a tradition of central bankers. There is a great figure in central banking history, Walter Bagehot. It's B-A-G-E-H-O-T, not bag-hot, speaking of sexy. But Walter Bagehot really sort of wrote the rule book. It was put to work in the great financial panic of 1825 and subsequent panics when the Bank of England was really the central bank of the world as we are today, or the most important central bank. And we opened the floodgates. This is our duty as a lender of last resort. Not something you want to do. You do it in a way that you make sure that you don't lose money. I mentioned earlier we didn't lose money on our programs. So we created several things, but the basic principle was to follow the rule book of sound central banking, which has been practiced now for a very long and established time. We had to make sure that we could restore, in the end, the trust that people have as counterparties to risk. If I lend the governor money, I'm hoping he'll pay me back. I'm not so sure, by the way. But we have trust in each other. And so interbank lending had to be restored. It stopped. The most basic instruments of finance that are needed for companies to conduct business, small and large, private and public, commercial paper, asset-backed securities lending. You have to remember the first money market mutual fund established in the United States, what they say, broke the buck. So you expect to get $1 back, couldn't get $1 back. We had to step into the breach and supplant those functions by leveraging our balance sheet and creating these exigent programs, as we call it, under an authority given to us by the Congress, an authority which, by the way, has now been denied us by the Congress, but they worked. So I would say the most important thing was having the steadfast determination to know we were doing the right thing, to debating it endlessly internally and yet acting on time, and sticking to what is our job description, in the end, to be the lender of last resort. Yes, ma'am.
Hi, I'm Lauren Johnson from Las Cruces High School, and I just wanted to know your motives for getting involved with the Federal Reserve.
Lauren. Well, this will sound sappy, but it's true. My parents are immigrants. I'm a first generation. I'm the first to be educated in the history of my family. I'm the first to go to university of my family. We owe a great deal to this country. They made me possible. I worked on Wall Street. I succeeded as a hedge fund manager. I know those are dirty words, but I built one of the first ones in this part of the country. I sold it just right. I was given the privilege of being the Deputy U.S. Trade Representative. I was made an ambassador. These are things that are the American dream. Most importantly, my very first job right out of business school was with a man named Robert Rosa. Robert Rosa was the great international financial mind of his time. He had been the vice president of the Federal Reserve System that created the system for trading foreign exchange and intervening in those markets, and had been Undersecretary of the Treasury under President Kennedy. And he became my intellectual godfather, and really, in a sense, became a father figure in my life. He taught me not only money, but how to make money. And he told me that once I had made money, I had a duty to pay it back. And in his vision, the highest form of public service, forgive me, Governor, because I know you render great public service, and forgive any elected politicians in the room, was to work for the Federal Reserve. When I took the job, I was offered by the Federal Reserve Board of Dallas. The formality of meeting with Mr. Greenspan, who was then chairman, he called me into his office. He called me the night before. He said, "I want you to come see me." And he said, "By the way, the answer is yes." I said, "Well, what's the question?" He said, "I'll tell you when you get here." So we sat down, and he said, "As you know, I think you know, we'd like you to be head of the Federal Reserve Bank of Dallas." He said, "But there's one requirement." And I thought, oh my God, what is the requirement? And he said, "You must always speak the truth." That's it. There's no higher form of calling than this public service. Yes, ma'am.
My name is Julianne Bell, and I'm a student at New Mexico State University. And my question is, how does Dodd-Frank change the way the Fed operates? And can you foresee any negative impacts this reform could have on depository institutions?
The answer is a lot, and yes, thank you. I mean, this is massive legislation. As you probably saw, it's not just the legislation itself, which is very long and many, many, many pages, but then the requirements put on the supervisory institutions like the Federal Reserve, I saw a figure the other day, I can't account for its validity, but if you piled all the pages of those, just little paper pages on top of each other, it would exceed the Statue of Liberty in height. We have certain obligations under Dodd-Frank. Other supervisory institutions do as well. We're all trying to deliver. None of us, I think, will be able to deliver fully under the time zone or commitment, rather, requirement initially foreseen by the legislation. But the one thing Dodd-Frank ended up doing was actually expanding the supervisory franchise of the Federal Reserve. There was an intention originally to limit our supervision responsibility to institutions of only $50 billion and higher. Several of us felt that that would skew our monetary policy decision making. They were going to take away, for example, community banks from our purview and the smaller regional banks. Well, it didn't end up that way. And actually, thanks to the active work of a senator from Texas, Senator Kay Bailey Hutchison, and many, many others on both sides of the aisle, they succeeded in getting 91 votes in that legislation to actually expand our franchise. And I mentioned earlier, add the thrift holding companies. In addition to that, they created a council chaired by the Secretary of the Treasury to consider systemic risk. In other words, if an AIG gets into trouble, what kind of systemic contamination might take place? The chairman of the Federal Reserve sits on that board. He's obviously a key player on that board. It is our duty as Federal Reserve staff to keep him informed. And I would say those are the direct consequences of Dodd-Frank. There are many others, but there are also indirect consequences. We learned by having to be the first responder in our lifetimes of having to do all the things I spoke of earlier, that even areas where we're not responsible in terms of our supervision, that are, say, supervised by the SEC or other regulatory agencies, we're the ones that have to step in and provide the liquidity to mend a broken fence. And therefore, we have to develop our peripheral vision. And we are now monitoring very carefully other areas that might present systemic risk where we might be called upon again. And the reason for that is we went through very harsh criticism, despite our success, I would argue, in stemming the crisis and pulling us back from the brink, because we were the first responder, as I said earlier. And Teddy Roosevelt had a great quote. He said that when people lose money, they strike out like a snake at the first thing that comes into their view. Well, there was Ben Bernanke and the Federal Reserve. We were the first that came into view, and Congress struck out like a snake against us. We became incredibly unpopular. People questioned the efficacy of what we were doing. The good news is it turned out right. We lived up to our commitment. I certainly don't want to have to go through that again. None of my colleagues want to have to go through it again. So we're going to work very hard with that legislation and do even beyond what is required by that legislation to develop our instincts and be better at what we're supposed to do.
My name is Anna Gramer, and I'm from New Mexico State University. In the past, the Federal Reserve has been seen mostly as a largely secret organization, and now it's taken a much more public position, as shown by Chairman Bernanke's public forum last week. Why has this changed? What has led to these changes?
Well, Anna, you're right. We are perceived as a secretive institution, and we perform services for the American public. As I said earlier, we had to do what is in the ordinary course of business, extreme actions to pull the economy back from the abyss. This raises doubt in the American public's mind. We live in an age where you and your colleagues have social media and instantaneous contact. We live in a cyberized age. And it's our duty to explain what we do. You'll notice that when I spoke, I explained what I hope was in plain English. The many things we do at the Federal Reserve. You wouldn't have folding money in your purse, or this gentleman to your right in his pocket. I assume he has a few dollars in his pocket. If we weren't the ones that made that possible. It's minted by the Treasury, but we then provide the circulation. They are Federal Reserve notes. Little things like that people need to better understand. So we are progressing from an era, for example, under Chairman Volcker, when they didn't even announce what they decided, had to let the market figure it out. We release a statement after our meetings, as I said earlier, release our minutes 3 weeks later. Every word hemming and hawing and but, and as economists always lead off every sentence, so's, so this, so that, so this, is released in a full transcript after 5 years. And now the Committee on Communications, of which I'm a member, there are 4 of us, two bankers and 2 governors, recommended that the chairman do press conferences. And we decided as a committee, having recommended that to the Open Market Committee, that be done 4 times a year when we put together our economic forecasts. Now, Laura Conniff has heard me say this many, many times as one of my directors, but I did learn one thing at Harvard when I was there in economics, only one, which was, according to my professor, John Kenneth Galbraith, that economic forecasting was invented to make astrology look respectable. And, but we still put our forecast together. We use the best modeling techniques we can. We think that's a good time for the chairman to explain better and to try to increasingly explain in plain English to not only economists, not only to the markets, but also to the American people, why we do what we do. So it's a progression. Now, we are about to have our 100th anniversary. We were established in 1913. The banks were put in physical place in 1914. I would argue that nothing that's 100 years old should provide a full frontal view. It's not very attractive. But I do think we have a duty to be more transparent. When I speak, I try to speak in simple English. That may be because I'm not a PhD economist, and I'm proud of it. I'm an MBA. I went to business school. But I think it's a duty of ours to respond more directly and take away and demystify, as I said in my speech, some of what we do. Thank you for the question, Anna.
My name is Sierra Salpek, and I graduated from Las Cruces High School in December, and I started my college education here at New Mexico State University in January. And my question for you, Mr. Fisher, is looking back at the Federal Reserve's actions during the economic recession, is there anything that you would have liked to have seen done differently?
Sierra, I would have liked to have had more sleep. The devotion of this institution to doing its job, I saw it from the inside, truly admirable. I don't think anybody lost more sleep, anguished more, thought more about it, say, than Ben Bernanke, who's a scholar of the Depression. And then those of us that have the privilege of sitting on that committee where we make a group decision and we work with the Board of Governors, every one of those facilities was debated and vetted and thought through and questioned about cost-benefit analysis, and we were under enormous pressure to do it in a short period of time. So I'm sure we did something wrong. I think, though, the net result speaks for itself. We're not in depression, and I can tell you, having looked at all the numbers from an insider's viewpoint, we were at risk of something even greater than the Great Depression. We have not experienced deflation, which becomes a risk when economic activity stops. And I think we did our job. So there's nothing that I regret, and there's nothing that I think my colleagues should regret, nor that the chairman should regret. Again, it's very difficult to communicate when you're on the battlefield. We were on the financial battlefield at the time. We had to fight that war, and yet we had to, of course, be accountable to our political masters, ultimately the Congress of the United States. And you know how the Congress of the United States works. I should say in front of the cameras, it works brilliantly. Yes, sir.
My name is Rich Puentes. I am a senior at Oñate High School, and my question for you, Mr. Fisher, is what is the Fed doing today to ensure that the recent downturn in our economy won't happen again in the future?
Rich, that's a very good question. And are you on the basketball team? Okay, good. Well,
I believe they won the state championship this year, didn't they?
This whole thing was set up to announce that Rich won the state championship. Mr. Puentes, I think I covered some of that in my speech, but basically what we have done is we went from having no liquidity during the crisis, everything stopped, to injecting an enormous amount of liquidity into the economy. Think of liquidity as the gasoline on which American businesses, businesswomen and men, run their businesses. They need access to funds. They need them priced at a price that they can use them. In other words, interest rates have to be low. And we have refilled the tanks. So we went from no liquidity to abundant liquidity. And now the question is, how that liquidity will be put to work and harnessed in putting the American people back to work. We have too many people out of work. I said in my speech that I think we had done our job. We've done as much as I think we can responsibly do without regenerating the ugly force of inflation. And now it's up to other incentives for businesswomen and men, public and private, large and small, to start rehiring. And by the way, to do so in a globalized economy, which you all have grown up with, which is new to us. My generation, the governor's generation, I won't disclose her age, but your university president's generation, remembers and lived through the Cold War. We won the Cold War. It was one of the greatest victories of all time. We spent an enormous amount of blood and treasure to do so. By winning the Cold War, bringing down not only the Berlin Wall, but what they call the Bamboo Wall, bringing China into the system, reinvigorating the desire of India to compete and stay alongside of China, billions of people were brought into the globalized economy that didn't participate before. This is good news. But the reason I mention it is because businesses don't have to invest here in the United States. We could prevent and thwart that by imposing capital controls or resorting to protectionism. We know that's the road to hell economically. You don't want to do that. So not only do we have to incent businesses to hire or commit more capital to hiring jobs, they have to be incented to hiring Americans when there are other people that want our money. And those businessmen, women, and men are free to invest anywhere in the world because we have open capital markets. This is a very difficult challenge. And I do think a big part of it is going to be, incidentally, providing confidence by the fiscal authorities, now that the monetary authorities have done their job, that we will not go down this economic sinkhole that's been put together by cumulative budget deficits and unfunded liabilities like Medicare and Social Security. I don't envy these tough decisions that have to be made by Republicans and Democrats in order to get our fiscal house in order and save our country for your generation. So there's a lot that has to be done. Yes, sir. Christy?
Good evening, Mr. Carruthers and Mr. Fisher. My question is: there's a lack of understanding of the Federal Reserve, and resulting distrust among much of the public. What should they know about the Fed to put them at ease?
Well, that's a good question, and I hope I've put you at ease with my comments and my speech today. First, I think we need to explain ourselves better. Secondly, I think people need to understand there are limits to what we can do. We are a monetary authority. We have no power to tax, no power to spend. That's what we elect people to do on our behalf, and we send them to the United States Congress, the lower house and the upper house. And we have a chief executive that helps working with them on that front. I think it's important for people to understand that we are a monetary authority only. There's only so much we can do. And there's a lot that we can do that would do more harm than good. For example, if we were to inflate our economy out of its budget duress, we would be performing a great disservice to our country, and we would be selling your generation short. We've seen it happen before in Germany, which became Weimar Germany, and the hyperinflation. We've seen it happen in what once was the 6th or 8th richest nation in the world. People don't believe this, Argentina, which destroyed itself by basically monetizing the public debt and what I call fiscal misfeasance. So I think we need to explain to the American people there's a limit to what we can do. There are certain things you don't want us to do, even though that may be the easiest way out. The easiest way out of dealing with debt is to inflate it away. I'll give you an example. If you were, under the old circumstances in Europe, if you were Greek and you were in the problems that Greece currently has, you would devalue your currency, which was called the drachma, and you would inflate your way out of the debt. It's a society that's done this for an awfully long time, as you know. They don't have that option anymore. They are part of the Euro system, and the European Monetary Authority will not allow that to happen. So now they have to make very tough decisions by their elected representatives to get their house in order. Either raise taxes, cut spending, a combination of the two. The message I'd like to convey here, and I'd like the American people to understand, I'd like you to understand as students, is we have the same responsibility as an independent institution within the government, not to debase our currency, not to inflate our way out of our debts, and basically do what is the limit of our job and not exceed that limit, so that those that are elected to decide how to take resources from the American people, reallocate them in spending, start doing it responsibly and restore the fiscal strength and the future of our country.
Richard, I want to thank you for answering the good questions from our students, well-prepared questions, and now we're going to take a little risk and turn it over to a couple of faculty members.
No, I'm really in trouble.
We only have about 6 minutes, so I'm going to start with Dr. Erickson with a brief question, if you would, and then Dr. Peach.
I'm Chris Erickson, Department of Economics, and I'll warn you, I've taught money and banking for about 25 years, so I've been...
I'm in deep trouble.
Yeah, there you go. The quiz is after the show. My question is that the S&L crisis amounted to about $150 billion damage to our economy, Mas or Menos, there's different estimates. Right. The current crisis has resulted in about $1.5 trillion in damage to our economy. Again, Mas or Menos, there's different estimates. But during the S&L crisis, 1,000 people were put in jail for malfeasance. In this crisis, which arguably with subprime lending, with liar loans, involved even more fraud and abuse of the system. I think the last count I saw was 7 people have been put into jail. What do you think? Is there a need for more effort in that arena, in the arena of supervision?
Well, first, again, when you think of the limits of my authority and our authorities, we don't have the ability to put people in jail. This is up to our civil system and our leaders and our lawmakers and our attorneys general. I would argue it's also up to the shareholders. It's not that people haven't gone to prison or gone to jail. One of the things that I think disturbs people is those CEOs or many of the decision makers that got the institutions we all know about into trouble. Many of them are still there. And in fact, many of those institutions are richer and more powerful and have a greater concentration, say, of deposits than they had before the crisis. And their compensation packages have been restored. So part of this is shareholder response. I'm frankly amazed that shareholders haven't been a little bit more strong on that issue. But it's also up to, again, those that make the laws and enforce the laws. That's something that we don't do. So it's purely a personal commentary. It's not within my regulatory responsibility to charge people with a crime, put them in prison. But it is noteworthy, and I think it angers the American people that what has happened, and the kind of question you just asked reflects what has happened. But again, that's the responsibility of our lawmakers and our law enforcers.
Richard and Dr. Peach, we're in kind of soundbite territory now, and we're about to run out of time. Have you got a soundbite question that he can give a soundbite response to?
Very quickly. Are excess reserves excessive now?
They're sufficient. Thank you.
See how
Thank you, Dr. Peach.
Yeah, see how influential a person can be. That's the first time Dr. Peach has ever been that succinct since I've known him, except when he talks about the potential for the Chicago Cubs, and sometimes he gets a little quiet during that period. Richard, that was a wonderful discussion for our audience, both watching at home and here in the audience. I like your style. You blew up the myth of monotoning that comes with Federal Reserve people. We always thought everybody talked like Chairman Greenspan and just kind of monotone. You make this subject matter exciting, and you make it interesting. And I would like to offer Dr. Couture will give me a faculty line here at the university when you retire. And we'd like to bring you back from time to time to talk to our students, because I think you would enjoy that, and certainly they would learn a lot from it. I noticed if I had to capture one thing about the Federal Reserve in this recent crisis, in a word, it would be agility. Would that be fair? You were agile enough, you have a small enough group, you could make decisions even though you weren't quite sure what the outcomes were going to be, but you could make them, and you could make them quickly. Would that be a fair assessment?
Yeah, I think agility and total devotion to our mission. Hawk or Dove, or whatever the perspective is, wherever they come from, whatever bank they represent or where they were put from the board, where they came from, Everybody's devoted to getting it right and to speaking to the truth to the best of their ability. So I'm pleased to hear your praise. I pray every night that it's deserved, and I think we've worked very hard to be deserved. I will say in conclusion, we are a faith-based currency. The euro is a faith-based currency. Mm-hmm. The faith and the belief in the integrity of that currency depends on the central bank. Mm-hmm. So we must be agile. We have to be deliberate also. Mm-hmm. And we have to do what's right. So we just pray that we've got it right.
And you have a deep faith in the United States of America, obviously,
yes, sir, I do.
By what you do. I want to thank a number of people who contributed to this, and I'll start with you, Richard, for a wonderful 1 hour with our audience. Secondly, Glenn Cerny, who is the Executive Director of University Broadcasting here. I did call him and ask him to do this, and he thought it would be wise to actually show this to the people of New Mexico. So this will be on the air in several communities around. President Couture for coming up and introducing Richard Fisher, and for her great leadership of our great university. Regent Laura Coniff for inviting you. Dr. Brooke and her NMSU students are here. Thank you. And we have Lupe Edens of the El Paso branch of the Federal Reserve for her work with high school students. And all of the high school and college participants, the New Mexico State University faculty, staff, and above all, our great audience interested in the very subject that you went over today that is so important for our state and our country. Thanks again for coming. Delighted to have you. Look forward to having you come back.
Thank you, Dean.